his PhD from the University of Seattle, and he has been working with math finance for a number of years, optimization, and he's going to tell us a little bit about incomplete markets. So Teemu, thank you very much for being here.
Thank you, George. And thank you, George, for bringing us all together in this beautiful place again. You made me a happy man again. I've been looking forward to this for all of the dark autumn in London, and this kept me going through the dark months. So indeed, I'll be talking about incomplete markets. The first part, where I have, I think, 23 slides, is something I put together based on, there's a course I teach in King's College London, master's course. The 23 slides here condenses what I teach over some 7-8 weeks. So put 16 hours into, let's see, 1 hour or so. So we'll be talking about incomplete markets. So incomplete market is a market which is not complete. And a market which is complete is something like the Black-Scholes model, something where you can replicate all the financial contingent claims that you might be interested in by trading in the liquidly traded assets in the financial markets. And when you don't have that, it means that if you're trying to hedge a claim, there's going to be hedging error. And it means that the seller of the claim is responsible for paying out the expected or the shortfall in the hedging process. And he also gets the surplus, and then that means that there's what do you say? The preferences of the trader comes in. So what the incomplete markets is about is subjective factors, and that's something that we are not trying to shy away from. So instead, we try to make that as the sort of the front page of the thing, where we develop a very simple model where the subjective factors of the traders explain the trading in the markets and explain why trading happens in the first place in the financial markets. And if you don't do that, you're essentially hiding away something essential in the markets. And that's what those classical complete markets models do. If you have a complete market where everything can be replicated, it means that those claims that you're trading, they shouldn't exist in the first place, because you could replace them by these hedges. They would be redundant assets. They wouldn't be there. Nobody would have introduced them in the marketplace in the first place. So it's really the incompleteness which makes financial markets interesting. Or if you think of any market where things are bought and sold, things are bought and sold exactly because agents have different needs. Agents are different. Some person is willing to pay more for the product than the owner of the product is charging for it. And that's how trades happen. And these, the prices that are agreed and negotiated in the markets, they indeed depend on several subjective factors that are hidden in the complete market models. There's risk preferences, which the agents use to judge the hedging error when they consider the shortfall or the surplus of their hedge as compared to the payout of the product they are selling or buying. They have to take some stance on agreeing that I like this shortfall because I like this hedging error because even though I may suffer in some scenarios, I make money in the others. So there's this kind of trade-off that will be modeled by risk preferences. Another simple thing. If you ever traded in practice, I don't need to convince you of this, that your views about the market development matter if you're buying or selling things. If you consider buying a stock, for example, you buy it exactly because you think that the market price will go up, and you sell it later, you make profits. It's an obvious thing, but again, a thing that never shows up in complete market models, which I think is strange. And then one of the most important and interesting things, I think, in this theory is that the financial agent of the agent should matter when he prices things. And that's, again, very obvious if you think of any transaction. If you ever bought an insurance contract, you bought it exactly because you had exposure to some risk. You buy a car insurance contract if you have a car. If you don't have a car, you're not interested in it. Even if you could buy it, you wouldn't probably buy it. And then the fourth subjective factor that I'm not going to talk about much in these slides is the trading expertise. That again should be an important factor for pricing of things. If you think of an insurance company who's good at replicating or approximately hedging their insurance products or whatever products they may be selling, they can afford to sell it at a better price. Just like iPhone or Apple is good at producing phones by putting together different components that make up the iPhone. They're good at doing that. They can sell the phone for a price that is attractive for many people. If I tried to do that, I would charge billions and billions for a single phone because I would have to go through such troubles to do that. So in a summary, everything is very, very, very much subjective in financial markets. It depends on the market sector, how subjective things are, how far from complete the market sector is. I will have an example into simple index option pricing where the market is not terribly far from being complete. And there we get some interesting numerical results where you still see the effects of these subjective factors, and it nicely illustrates the whole incomplete markets theory in a very simple setting. So in these first 23 slides, I plan to, well, there's roughly the outline. I plan to look at, first of all, optimal investment with liabilities. That's what I call the asset-liability management problem. The name is there just to emphasize that we are really looking at liabilities in an asset management problem. And that's crucial when you go into valuations. Your hedging strategies, they live in the same ALM model, this asset liability management model, also known as optimal investment with liabilities. It's sort of the theoretical, mathematical umbrella for all of this theory. Within this ALM model, we can then build those pricing problems, the pricing principles, and we can study their properties. And it also provides this, like the computational framework for doing those things, for pricing things. And we'll see that in the example with index options. Then the last section is on duality. I think I'll postpone that after I go through the options example, just because I think it's nice to see a concrete example where you see how this how this theory works out. And then within that context, I think the options context, people are often used to seeing duality there. So I think probably makes more sense to look at the duality after the options example. Oh, that's what I've roughly covered. The last part here, I'm not sure if I will have time for that. I have two sets of slides, 23 on this general incomplete markets theory, and then in the second I have a set of slides for the options example. I have a third set which is more mathematical. So one thing that I should have emphasized already is that what I have on this first set of slides is the simplest mathematical model that I could come up with in which you can still discuss asset liability management and valuation of contingent claim in an economically meaningful way. And indeed, I've tried to, partly because it was based on a course for our master's students, who are not very advanced, unfortunately. But I also think it's nice if you can develop the economic theory with minimal mathematics. And indeed, my emphasis here is on the economics of things, not on the sophisticated maths. So I tried to really push the maths aside and leave room for these economically interesting things. So in the last part, I deviate from that. There's a more recent paper which I think it came out or is coming out soon in Finance and Stochastics, where we look at this dynamic multi-period model, finite discrete time, with illiquidity effects, and then we develop the same kind of ALM theory and pricing theory for contingent claims in a dynamic setting. But I'll do that if I had some. And also in that, one of the main parts was the duality theory. And I could say again that all the duality theory here, I'm not using a Gersonov's theorem or stochastic calculus. Everything is based on simple convex duality, going back to, I don't know, Minkowski, Rockefeller, Fenchel, more than half a century ago. And it's nice in that it really does yield those most general martingale representations of these indifference prices and all of that. You're not losing anything, you just simplify the theory compared to the classical financial math. But anyways, here's a list of references if you're interested in more references and background and the details of the proofs. There's an earlier paper which I presented in the International Symposium on Math Programming some years ago. Then this paper here is fairly simple one. It develops the ALM theory and the pricing theory in a discrete finite time setting with illiquidity effects. No duality there. The duality of that model is developed on this one that I briefly mentioned. It should be coming out in Finance and Stochastics soon. Then if you're interested in the general duality theory in convex stochastic optimization, you can find some of that here and its references. And this has nothing to do with finance per se. It's about general convex stochastic optimization models that do cover financial trading models, even with illiquidity effects and portfolio constraints and so forth. And this paper on duality for convex stochastic optimization is based on this beautiful book by Terry Rockefeller from the early 70s, where he develops, one could say, the most general theory for convex optimization. When Terry started working on these topics in the early 60s, that was a time where linear programming duality was already established. I think the first versions by von Neumann. And then Fenchel duality was already created. And then what Rockefeller did in his early work, he brought everything together in a very, very general functional analytic framework of convex optimization duality, which covers, you can say, everything in convex duality. Fenchel model, the linear programming duality, Lagrange duality, and so forth. If you ever worked on convex duality, if you didn't do it this way, then you're reinventing the wheel or doing something wrong. So if you're ever interested in convex duality, please look at this. That's still the state of the art. There are many tricks that one has to attend to when going to stochastic models. And in particular, if you want to cover for example, the fundamental theorem of asset pricing, which relates no arbitrage conditions to existence of martingale measures, there's some tricks, nice tricks coming from measure theory and financial mathematics developed by, I think, Schachermayer and his collaborators, where those tricks can be used to replace some compactness assumptions that are needed to get the duality work. But besides that, everything is still within the conjugate duality frame. The last reference here is where we report the results on the options pricing model that I will be presenting as well. It came out or is coming out in the special issue for Rio, I think, was the second one.
Just came out.
It did?
Yeah.
Happy to hear. I'll buy that. So then the model. Like I said, I'm going to develop things in this very simple stochastic model of financial markets. It's a single period model where we buy something today, we hold it over the one period, we don't touch the portfolio during that. When we get to the maturity, we pay out the claim if we have sold one, and we liquidate our portfolio and see what we get. What you get is the net wealth, that's the hedging error. And we try to come up with a portfolio which is as nice as possible in the sense that the net wealth at the end of this period is nice in terms of some risk preferences, some risk measure, expected utility or something like that. So the notation, assume that the agent has W units of cash at time 0. That's when he first trades. He faces a liability payable at time t equals 1. Liability is denoted by C, so that's the number of units of cash the agent has to deliver. Like I said, the problem is to find the investment strategy, or in this case, just the portfolio to be held over this period. And all the random variables, so the investment returns, the claim here, the C that the agent is liable for paying, everything will be modeled as random variables in some fixed probability space. For now, we assume that the market is perfectly liquid. That's not necessary for the theory at all. I just do that in order to simplify notation and the model, so you don't have to waste capacity on thinking of that instead of the economic implications of things. So we assume that everything is liquid. There's a finite set that I denote by capital J, finite set of assets that are traded in the market. They can be traded at time 0 or time 1. The unit price of asset J at time t will be denoted by S sub t super J. Those will be random variables. So I'm not assuming any integrability, they're just in L0, so it's the equivalence class of all real valued random variables. In vector notation, when I drop the super index, I mean the whole vector of prices, J running through this set capital J of traded assets. In particular, at time 0, the prices are assumed to be known, so you observe the prices before you trade. It makes the price vector at time 0 deterministic. The price vector at time 1 will be an Rj valued random vector. So in this perfectly liquid model, if you buy a portfolio X at time 0, the cost of doing that is simply the dot product. You multiply the numbers of units X by the price vector. So X indeed is a vector of units of assets that you buy. Then you hold it until time 1 and you sell it off, and that's the liquidation value, S1 dot X. S1 is a random vector, so it makes your liquidation value a random variable. X is a deterministic vector you choose at time 0.
So you can have a negative position as well.
Yes, yes. So like usually in math finance, negative positions are just you short sell something. And I assume that all the assets are perfectly divisible. So X indeed is in a whole Euclidean space. We will have portfolio constraints if you say that in some situations you can't sell things, then you can put a portfolio constraint here. But I still assume that all prices are liquid. Of course, that's not realistic. In practice, you always have bid-ask spreads. And you always have finite quantities on those best price levels. And you really do get nonlinear trading costs in practice. I developed that in the last part if I have time, but conclusions in terms of economics will still be the same, that this ALM problem hosts these pricing models and all that. And indeed, since we are taking this like convex optimization viewpoint of things when we develop the theory, it really doesn't matter what your market model is. It's still convex. We still use this. The same functional analytic techniques works. It really doesn't matter what your market model is. The theory remains the same. I should have emphasized that before we get to the duality, everything here is really, really simple mathematics. It's purely algebraic, and just using properties of convex functions and nothing else. Convex functions and convex sets. So convex algebra proofs are 10-line proofs. When you get to the duality, you need some separation theorems and some simple functional analysis, but it's still a classic convex analysis. But the interesting economic things, I think, happen here in the primal space. To me, the primal space is where trading occurs. For many people in financial mathematics, the primal area is where the Martingale measures live. For me, that's the dual space. And indeed, you can derive those things from the duality theory. But the economics happens when you trade things. So that's here. When you see X, that's the real work part. So this is the ALM problem that I will be looking at. It's the problem of the agent choosing the portfolio X, subject to there may be some portfolio constraints. So D here is some set of allowed portfolios. So it's a subset of the portfolio space Rj. There's a budget constraint. So if you remember, the agent was endowed with W units of cash at time 0. So he has to obey the budget constraint. He can't spend more on his portfolio than what he can afford, what he's given. And then his objective is to minimize this. So what you see here in the argument is the claim he is liable to pay. He can cover part of that by the investment return. So this is what he gets at time 1 when he liquidates his investment portfolio. So that liquidation value covers part of the claim. If you're on complete markets, you can always make that 0. In incomplete markets, that rarely happens. So this difference here usually is a non-trivial random variable. Remember, S1 is a random vector. C, the liability, is a random variable. So the net wealth after we have liquidated our portfolio, paid out the claim, the net wealth after that is a random variable. And we want to make that random net wealth, sorry, it's not wealth, my mistake. It's the net claim. We have to come up with this much money more. Negative of that is the net wealth. I'm confusing myself. So you cover part of the claim by your liquidation value, and the rest you just have to dig your pockets. You have to go to the owners of the company and ask for more capital. We need to cover this thing.
Yeah, the point is he wants to maximize the net wealth,
yes,
therefore minimize the difference between C and...
Exactly, yeah. So I've just flipped signs. In economics, people would usually maximize some expected utility. In optimization theory, people, I don't know why, usually look at minimization problems. I converted everything into minimization. It's just a question of flipping signs. Martin?
Is there a simple way of making this state dependent, meaning that you have some information already at time 0, so your X and your W could be variables, not F measurable, but say F0 measurable?
Yes, you could. Nothing would change. You would require this constraint to hold almost surely. I mean, if you look at the model, if you want to allow X to be a random vector and W a random endowment, it's still a well-defined model here.
Well, D would be random as well, right?
It could be, yeah. In the dynamic setting, that's exactly what happens. The portfolio constraint will be modeled by a sequence of random convex sets. The trading cost will be modeled by a sequence of random convex functions. And all that, good point. But here, I assume that when we trade at time, well, everything is conditional on the information at time 0. So that makes X deterministic. And I'm not going to those conditional things simply to keep things simple as possible here. So yes, this is the problem. And then, like I said, C minus S1.x is the net claim that the agent has to cover by digging his pockets. And he wants to make that as nice as possible. In general, it's nice if it's small, but it's random. So well, it's just a classical topic of comparing different random wells. You can use expected utility, you can use mean variance or whatever. V here is just any risk or any function from the space of random net claims to the extended reals. I do want to allow extended reals so that I can cover, for example, super hedging. That corresponds to the case where the agent is as risk averse as you can get, which is when the agent becomes infinitely unhappy if there's any positive probability that this guy here is strictly positive. And in the other case, the agent doesn't care. The value of V would be 0. In any natural or, so that's more of a mathematically interesting case, the super hedging with that kind of a extremely risk-averse agent. That's mathematically interesting. I will be looking at that, but for any practical purposes, any of us would have something more reasonable. We don't die if we have to deliver a couple of pounds at the end in case our hedge doesn't cover the claim. So this is the problem. We try to minimize, optimize some measure of the net random claim, or equivalently, our net payout at the terminal time. Here's a simple example just to tie things to what we know. In the mean variance case, if your risk measure is this expectation plus some multiple of the variance of this net thing here, then you can write this optimal investment problem as a quadratic programming problem where you have the usual variance term here, but then, and you have the expectation term. The only new thing compared to the Markowitz model is this correlation term. This sigma C S1 is the vector of correlations between the prices S1 and the claim C. So what this term does here, it encourages investments in the assets that correlate strongly with the claim. So if you want to hedge the claim C, that makes perfect sense. If you have this quadratic risk measure, it's enough to look at the correlations. You want to put your money where the correlation is high. It's an approximate hedge. And then again, to emphasize the subjectivity. The way you see it here is obviously there's some probability measure. We have a probabilistic setup. All the random variables are modeled by some probability. Random variables as random variables in a probability space. That describes our views about the future. If you think that the IBM stock price is going to go up, that's in your P and the specification of your random variables. That's where you feed in your views into the model. Obviously, the function V is important. That describes your risk preferences about the net claims you have to pay at the terminal time. Your financial position described by your initial wealth and the claim you're liable to pay, that obviously affects the solution to this problem. So your trading will indeed, the optimal trading will depend on these subjective factors. Anything that affects this problem, which are the views described by the probability space and the random variables, the risk preferences encoded by V, and your financial position described by your wealth and the claim. And already here, it's good to note that every one of us has different subjective factors. We all have different financial positions. That explains why we invest differently. We have different views about the future. I bought Ethereum last year. I thought it would go up even further. It didn't. It was a bad bet, but that was my view. That's why I bought it. And your financial position. Again, if your claim here has something to do with you potentially crashing your car and incurring some expenses, you might want to buy a car insurance contract. You might want to include car insurance in your investment portfolio. Or if you have a home, you probably have a home insurance contract and so forth. Or if you bought some stocks, you might want to buy a put option to cover your losses. It's like an insurance. So it should be fairly natural. All these affect your investment decisions. And they will affect your pricing of things if you were to trade things. Then the maths. I will assume that the set D here is a convex set. I will assume that this function V that describes your risk preferences is a convex function on the space of random variables. I'll assume that it's non-decreasing. That means that agents always prefer to have more cash. They never want to throw money away. That's not the case in the Markowitz model. I will assume that it will be non-decreasing. I will be modeling more rational agents than the Markowitz model does. And for convenience, I assume that the set D contains the origin and that the function V is normalized so that they takes the value 0 at the 0 random variable. You might think that the convexity of the function corresponds to risk aversion of the agent. If you take two portfolios, you take a convex combination, you end up with the convex combination of the net payouts, and that should reduce the risk as compared to the convex combinations of the values of the risks. You might think that the convexity of the constraint D corresponds to sensible regulation or internal risk management requirements of a company. If the set D is not convex, this becomes, in general, an NP-hard problem. Sensible regulation would not pose that. If you look at any regulatory standards, they usually do indeed have convex constraints. It just makes sense. If it wasn't convex, if V wasn't convex, this would be a very, very difficult problem to handle. And all the mathematics, the simple mathematics that I cover here, is based on this assumption. It makes this a convex problem, and everything just falls to place. Martin. That's a good point. Yeah, I later will assume that the function V is the expected utility, or expected disutility, expected loss. And then you're taking the expectation with respect to P, and then it becomes clear. This, I agree. I thought about it. This may be a bit confusing because you don't see P. It's somehow hidden here. Yes?
Actually, it's in 0, right?
Yeah, that also, but that's a very weak dependence on P, only up to the equivalence class. Think of the expected utility. That's the case where the duality theory works. We need it in. We need an expected utility to develop the duality theory. We also have expected utilities in the numerical examples with options. Yeah, think of expected loss or expected disutility. And then the first result here. We will denote, and this is central to all the developments in the pricing, we denote the optimum value of this problem here by phi of W and C. So given an agent with financial position described by his initial cash endowment W and his financial liability C, compute the optimum value here over all portfolios X and denote the optimal value by phi. That's the thing. And when we go into pricing and hedging of things, the question there will be, if an agent sells something, he will be changing his initial endowment. He gets some money when he sells something. When he sells a financial product, he also changes his liabilities. So in trading of contingent claims, you're really looking at how things change here when you change the financial position. A sale or purchase of things changes your financial position. And when you go to pricing, I will be looking at indifference pricing in particular. The question is exactly how does the optimal value change there? So this is an important function when you go into valuation, and lemma 2 here gives the basic convexity properties. It says that this function phi on the space of all financial positions. So the space of financial positions are all cash endowments, which is a scalar in R, and all liabilities, which is the space of random variables. On this space, the function phi is convex, jointly in W and C. It's fairly obviously, it's non-decreasing in W. That's because we assume that your function v here is a non-decreasing in the natural order of random variables, the pointwise order of random variables. So the optimal value is non-increasing in W and non-decreasing in C. And if you take an agent with 0 financial position, the optimal value is less than or equal to 0. That comes from the normalization assumption. We assume that when you evaluate this function v at 0, you get 0. And non-increasing in W simply means that if you give the agent more cash, he can only do better. He has more freedom to choose his portfolio. He can obtain a better minimum here. If you increase the liability C, then you make this objective bigger because V is assumed to be a non-decreasing function. Any questions here? And the proof of this lemma is really just simple convex algebra. Just inequalities and no topological, no measure theoretic tricks, nothing. Simple algebra. Really, really easy. And all the results on pricing will be based on these properties. That's all you need. And actually, when you go to pricing, all you need is this structure, the function phi. You don't need the market model or the preferences or anything. It's enough to have this lemma too, if you look at the proofs of those pricing theorems. So that in particular implies that you can generalize your market model as you wish. As long as things remain convex so that lemma 2 holds, then all the pricing theory works just the same. But I will only do that in the last part of the mini-course. So then to pricing. One interesting feature about incomplete markets is that there's more than one interesting notion of a price or a value. And I've tried to make a distinction between the two. I developed the simple theory for the two. The first one, I will call it the accounting value. That's something that corresponds perhaps more closely to the classical Black-Scholes price or relaxation of that. You may have heard of good deal bounds, where you don't require replication or super replication, but you allow for some shortfall or something like that. You look for the least amount of initial cash that would be enough to find a portfolio that covers a sufficient part of the claim that you're liable to pay. And it leaves you with acceptable risk. That's the accounting value. If you read any, I mentioned Solvency II and in the International Financial Reporting Standards here, if you look at any of these accounting standards or what they say about how liabilities in a financial institution should be priced, they talk about something like this. How much cash would you need in order to transfer your liabilities to a third party so that they could cover the claims until runoff? That's why I call it the accounting value. It comes from accounting standards. The second notion is more relevant in trading. It's the classical indifference price, going back to Hodges and Neuberger in finance and even further back in history in actuarial mathematics. In insurance, it's often called the, zero utility principle or something like this, like for pricing, determining the premium for an insurance contract. And unfortunately, I haven't found a single text in financial maths where they make this distinction, that there are two practically relevant notions of a price or a value which have very different meanings and different interpretations, and the values can be very, very different. Both of these notions have been discussed extensively in financial maths, in books and papers, but I haven't seen anyone making a distinction between the two, because they are really economically important notions, both of them, and they are very different. Question?
What do you mean by what do you mean by the Black-Scholes model in your list?
Black-Scholes?
Here.
Well, yeah, I was just thinking of, if you look at the Black-Scholes paper, they framework the question by saying that you look for the least amount of capital that allows you to hedge the thing, or what's the initial capital needed to hedge the thing. When you start to generalize that, then you end up with something like this. If you be more modest and you don't look for exact replication, but for super hedging or even some more reasonable hedging, then you end up with good deal bounds and things like this. So that's all. I think it's when people start to extend the Black-Scholes pricing principle from from replication to super hedging or something more reasonable, I believe that's the kind of line of thinking. They have extended the Black-Scholes. Whereas the indifference price is builds directly usually on the optimal investment problem, like in the Hodges and Neuberger paper. I mentioned actuarial mathematics on this context, but in that context, I think at least traditionally, they rarely look at financial markets beyond one asset. But they still have the same principle, the zero utility principle. What's the happiness of the agent before and after they have sold this extra insurance product? And again, views affect them both. So in the accounting value, the agent's existing financial position doesn't come in, but it still depends on the views and the risk preferences. The indifference price also depends on views and risk preferences, but it also depends on the agent's existing financial position before the trade. So this is how you can describe things like you don't buy a car insurance contract unless you have a car. Having a car affects your initial position before the trade. In this context, you can describe mathematically why would you want to buy a car insurance contract. You can't describe that kind of things if you're looking at valuations like the accounting value. Like good deal bounds, they cannot explain why a homeowner might want to buy an insurance contract on the home. And also, as we all know, I think one of the reasons why Black-Scholes model was so popular and became so successful was that it was convenient because it didn't involve any of these subjective factors. It's nice. You don't have to put your bum in the line by saying that I price this thing because I think that market may evolve in this way or that way. You can wash your hands from that and be neutral, and you don't need to explain your views. But in practice, when you cannot replicate, you can't get around that. Otherwise, you get something silly. And indeed, you see lots of that, for example, in insurance regulation and insurance literature. If you look at Solvency II and regulatory standards, they are seriously discussing what should be the discount rate. The way they often value things in actuarial or the insurance world is they take some prediction, or what they call the projection of the insurance claims, which is a single scenario most of the time. And then they discuss how should we discount these claims to net present value that somehow reflects the true value of the insurance portfolio, insurance contract. That's silly. There's no economic grounds for that. You should only use discounting for pricing fixed income products like bonds. That's what the yields were defined for. Discounting works nicely for deterministic cash flows, but not for anything else. If you try to do that, then you just get paradoxes and confusion. And it's kind of entertaining to look at what goes on in the insurance world. They are still discussing these things. How should we discount things? In the UK, there was a big debate last spring about the university pension system. There were strikes and all of that. It was exactly because they came up with silly valuations for the university pension scheme liability valuations. Again, based on these very debatable discount factors. They won't ever find a reasonable answer to that because it's a trick question. You shouldn't be discounting in the first place. Things are subjective. You should model those subjectivities from the beginning. If you try to get away from it, then you're doing something wrong.
Do you think the mean difference price depends also to the cost? So I'm building on HFT, I get paid to trade.
Yeah.
In a hedge fund, I pay 2 bits, I'm a retailer, I pay 10 bits. So my different price are my cost of trading.
Yes, I mean, if there's costs of trading, that kind of things could be worked into the. Sorry?
Can you repeat the question because it gets recorded?
I think the question was that what happens to prices if you incorporate the trading costs or costs of capital?
Different agent at different trading costs.
Exactly, yeah. That's not covered by this model yet. You would model that kind of things by your market model, your portfolio constraints. If you have some cost of capital, that should be worked into your market model. Different agents indeed do have different market models. We have different constraints and we have different costs for trading. I don't have the same access to markets as some large banks have. I have one internet broker. I'm sure HSBC gets better deals when they trade options, better prices than I do. So those things should be worked into your market model. I assume this very simple, perfectly liquid model from the beginning. For now, that already is unrealistic. You shouldn't stick to this when you go to real pricing. And also the portfolio constraints. Yes, Ernst.
Yeah, your remark about the discounting, I think, is a very dangerous thing, what you say. Because why do we discount? Take a life insurance company. So they get the premium now and they have to make a payment 30 years from now. But in these 30 years, they make money with it.
Yes.
So, of course, the silly thing is what insurance companies still do, and even the supervisors do, they take a non-random discount rate. I mean, this is totally silly.
It is.
Because we know that even tomorrow the rate will be different. But discounting in itself, of course, is necessary.
Okay.
For future claims.
Yes, yeah, I agree. If you allow for stochastic discounting, then we get to the duality theory of things. But if you do it reasonably, it's simply a dual formulation of things that happen in the primal world when you're trading. I mean, that will be part of the duality world. You also get martingale measures. If you simplify a model enough, if you assume perfectly liquid cash, you get martingale measures as your dual variables. If you don't assume that, then you get these stochastic discount factors. And then I believe one gets something that you were alluding to, that discounting can make sense if you do it properly. But if it is to make sense, it has to have this duality correspondence. There has to be this economic world of a primal hedging problem that it describes? Good question or remark. Yes, so after that propaganda about different pricing principles, here's the mathematics. Here's what I call the accounting value. I denoted by, so we are trying to value a liability that an agent would have to pay out in the terminal date, this C, random variable. And the accounting value for delivering C is denoted by pi super 0 lower s. S refers to the agent being in a short position in this claim. It's something that the agent has to deliver in the terminal date. We define it as the least amount of initial cash so that the optimum value in the ALM problem is nice enough. What's nice here is simply the value 0. You could have other values here. It's not really important. But the question is this: how much cash would you need today in order to cover the claim, and so that your net position in the end is nice enough? So here we measure the niceness by the objective value of the ALM problem. And maybe to get a better feel for it, what it means a bit more explicitly, if you assume that I go back to the ALM problem. If you assume that the optimal portfolio X exists for every W and C, in general, there's no reason to assume that the optimal portfolio exists. You might be able to find slightly better and better and better, but never really the optimal thing. It's not a big assumption to assume that it does exist, but one doesn't have to. If you do assume that it exists, then the accounting value defined as such can be written as the optimum value of this optimization problem, where you explicitly constrain your risk of your terminal net claim to be less than or equal to 0. You look for the portfolio in the set of feasible portfolios so as to minimize the initial cost of your hedging portfolio. So that's the accounting value. Least amount of cash you have to invest in a hedging portfolio that is good enough hedge in terms of your risk measure. If you go back to this beautiful paper by Arsene, Delba, and Aber and Heath, it's exactly the same thing. The main difference is that they assume that the market is described by a single asset. They have one asset with the random payout. That was the R in their paper, lowercase r, which unfortunately in the later literature on risk measures disappeared because people normalized things in terms of this liquid asset, and then many people lost track of the interpretation of the translation property. But it's exactly the same thing. And if you look at the story when they developed this notion of a risk measure, exactly the same story. How much capital would you need in order to cover your claims? The only difference, like I said, is that we incorporate the market model here. Although it's simple, but it's still a market model. And if you look for the dual formulation of this, you get what is often referred to as the no good deal bound. That will be developed in the last part. So that was the accounting value for a liability. You can also talk about accounting values for an asset. If you think of banks, like banking supervision or regulation, or how banks are often set up, they often have something what's called the trading book and the banking book. In the trading book, you have liquid assets that the bank trades maybe, I don't know, daily basis. In the banking book, there's more illiquid assets and that you can't just mark to market in a sensible way. But banks nevertheless have to come up with values even for the illiquid assets in their financial statements. And if you think of some very illiquid loan that the bank has given out, it has value. It needs to be priced, even if the loan is subject to huge credit risk or optionalities or whatever. It needs to be priced. And that's what this accounting value for asset is after. If the bank was to receive this claim in the future, how much cash could they give away today and still find a portfolio within the budget constraint that they end up with the acceptable terminal position? You just flip these signs here and there, but you can express it as the negative of the accounting value of the negative of the claim. Just trivially flipping the signs, looking at the definition. Yeah. Any questions? Martin. Oh.
But he has to repeat the questions. That's the rule. Can you go back one slide? So isn't this the accounting value of a liability, assuming that you have zero initial wealth?
Indeed, it is.
So it could so you could also include initial wealth, and then the accounting value might or should depend on that, right?
That we will have exactly in the indifference price. But if you look at accounting standards, for example, Solvency II, I think it's Article 76 or something like this, they start by verbal descriptions of what they are now after before they go into the specifics and mathematics. And the verbal description makes good sense. They say that what would be the amount of capital that should go with these liabilities if these were transferred to a third party who has to take care of the business then. These kind of things are relevant in accounting and supervision in situations when a company goes bankrupt. It falls to the society. And then indeed it is interesting that if you have these liabilities to take care of, how much cash would you need to be sort of solvent? And that's, I think, what the regulatory standards are after. They are after the bad case where the company goes bankrupt. How much money would we need then? Whereas the indifference price is more about the ongoing business. Nobody's going bankrupt. They're just updating their financial positions by making these trades, and then the indifference price is relevant. And there, of course, your initial wealth and your existing liabilities will be relevant. So so I'm going to have a very simple statement about how to bound those accounting values in terms of these super hedging cost and the sub-hedging cost. So the super hedging cost, as you know, is the least amount of initial capital, so we're minimizing over the initial capital, that allows you to buy a portfolio that covers the claim almost surely. So here there's no risk preferences. We require that we are solvent in every possible scenario. And the sub-hedging cost takes the flip side of that. How much cash today could you give away? Or how much cash could you generate by shorting the traded assets and by closing your positions at the terminal date if you were to receive the claim C? So these are the kind of the upper and lower bounds for the claims. And then you have this result, which again is proved by very simple convex algebra. Nothing fancy happens here. So first of all, it says that the accounting value for a short position is a convex function of the argument, the liability you want to price. So the accounting value will be a convex, non-decreasing function. The accounting value for the zero claim is non-positive. We always have that the super hedging cost dominates the accounting value. And then if the zero claims price is not to something non-positive, but if the value of the zero claim is exactly zero, so then you get these sandwich inequalities. This assumption here gives the middle one, saying that the accounting value for a short position is higher than the accounting value for a long position, which is very natural from any regulatory perspective. Otherwise, there would be regulatory arbitrage. You could short and long the same liability at the same time, put them in your both sides of a balance sheet, and miraculously you would have a better net position. And then you have this super hedging cost and the sub hedging cost that bound everything. And then the last part of the theorem says that if the claim happens to be replicable, then all these numbers are equal. For replicable claims, the super hedging cost and sub hedging cost are equal. And then the sandwich inequality says that now these accounting values are equal to those things as well. In particular, in that case, for replicable claims, none of these subjective things matter, because the super hedging cost, I'll go back to the previous slide, the super hedging cost doesn't depend on your risk preferences, and it doesn't really depend on the measure P either, because this constraint that things happen almost surely, it only depends on the null sets of the probability measure. It's a very weak dependence. So essentially, the subjective factors don't come into the super hedging or sub hedging cost. And when these are all equal, then the same applies to the accounting values. They are not subjective after all, if the thing, the pricing, is replicable. But that's, of course, a lot to ask. So replicable here means that you can find a portfolio which is not only feasible, but the negative of it's feasible as well. Of course, this is always satisfied if you don't have constraints. And the payout of the portfolio is exactly equal to the claim. That's replicability. But otherwise, these bounds may be very far from each other, and these things may be different, and those things, the values are then indeed subjective. Question?
What was PL?
Pi L, that was the accounting value for a long position in the asset. Like if a bank has some illiquid loan in their books. So that's that. Yeah, then these remarks, I think I mentioned them. Then the next notion of a value, the indifference price. So here we are looking at an agent who already has some initial wealth, I denote that by W bar, has some initial liability, denoted by C bar. And then the question is, if he were to trade something, he would change his financial position. If he was to sell an additional claim, his net claims after that would be the claim the liability he already had before the trade, plus the new claim that he just sold. And his initial wealth would be changed from the C bar that he already had to, W bar that he already had into W bar plus W. W would be the price that he's charging for selling this additional claim C. And now the indifference price looks for the least price W, so that the agent can enter the trade without worsening his financial position, as measured by the optimum value in the ALM problem. So we assume that the agent trades optimally before and after the trade. Exactly the same principle as you see in the Hodges and Neuberger. That's just different notation. And of course, you can define an indifference price for buying a claim. In this situation, the agent's initial position would be changed into this. So if you buy a claim, you subtract that claim from your net liabilities, but you pay the price for it and you subtract that price from your initial wealth. Again, just by flipping signs here, you can see that the indifference price for buying is the same as the minus of the indifference price for buying the negative claim. And just like the accounting values, things here do depend on your views, the probability measure, your risk preferences. But now, in addition, with what we didn't have in the accounting value is this agent's net position before the trade. And that indeed is important, like you can imagine in the case of a homeowner who buys a home insurance or things like that. And then we have a very similar result, again, bound in those prices between the super hedging cost and the sub hedging cost. In particular, for replicable claims, all these collapsed into a single, the same number. For replicable claims, none of these subjective factors matter, which would be quite a miracle. And in particular, if agents have same subjective factors, same views about the future, same risk preferences, exactly the same financial position, they would never trade with each other, because this inequality here that says that one agent would be asking for a price which is higher than the other agent would be willing to pay for it. Transactions would not occur if those agents were identical. But in practice, of course, we're all different, and that's why we trade. This inequality doesn't hold if you look across different agents, and then trades indeed occur. And yeah, the third part is comparing the accounting values with indifference prices. If you do assume replicability, then you have this same no arbitrage bounds here on the both sides, both for the indifference price and the accounting value. And you get the fact that accounting values and indifference prices coincide for replicable claims. They both coincide with the super hedging and sub hedging price. But if you're beyond that replicable case, then there's no reason to assume that the accounting values and the indifference prices will be the same. Then I will go to do duality, but I think I would rather go to the options example. I'll come back to this duality after that. So I think I have 20 minutes before the coffee break. I should be able to cover most of this. So this is based on the paper that just came out in the Rio issue. And John Armstrong is a colleague in King's College. He was the one who first developed the code for computing these things. Udomsak is my PhD student who has been doing the practical computations with real data and looking at the results. So this is just saying the same thing that I've been advertising the whole morning here. ALM provides a nice umbrella framework for pricing things. In this presentation, in this example, I'm only looking at indifference pricing, not the accounting values. And here's the problem. So I'm looking at a very simple market sector, which is the European options on S&P 500 index. I'm looking only at the nearest maturity, which is some 30 days away. And I'm only looking at trading claims whose payouts only depend on the value of the index at maturity. So there's only one uncertain factor here. It's the index value at maturity, and that factor determines all payouts of the claims that I'm considering in this optimization problem. So modeling-wise, things are simple. We only need to model one scalar-valued random variable. We're not going to model the process even, just the value of the index at the maturity. And the nice thing about this market sector of S&P 500 index is that there's hundreds of strikes that are traded. You get quotes for buying and selling prices for hundreds of call and put options on this single index. So the traded assets here are calls and puts, denoted by capital P, the payout when you take X units of the asset. For calls, obviously, you have that the positive part between the index and the strike. For puts, you have that. Also, we trade futures contracts for futures. There's bid and ask quotes on the futures price. KA when you go long, KB when you go short. there's cash, we assume different lending and borrowing rates. What's nice about these things that they are all concave functions of your x, your position in them. These minimums, they always give concave functions, positively homogeneous.
Teemu, could you put binaries there too? Did you try binaries?
You could, but you don't get quotes for them. We'll price binaries. I'll show you. That's at the end, the computational results.
Okay.
So what we're looking here is really we're going to take quotes, live quotes for the traded options. The S&P 500 index options are exchange traded. You can get we'll take a snapshot of the market. We take the buying ask price and the bid price. We also look at the quantities available at the best prices, and then we are asking the question, how should we trade these options given these prices? That would be the thing. If there are quotes for any other options, we can incorporate them too, no problem. But I don't think binaries are exchange traded.
Chicago, yes, I think
They
so.
are?
Yeah.
Really?
Chicago, yeah. Perhaps Jim can correct me if I'm wrong, but
I believe that's true. I never looked at the quotes, but
yeah.
Well,
Chicago,
that's nice.
yes.
Okay, that means that we could expand our
Yeah.
trading space by those options. Yeah, interesting. I didn't know. Thank you.
Chicago for sure.
Yeah, I
CBS.
think our quotes also come from Chicago for the European options. We'll look into that. I had no idea. That's a good point. But already with these, we have hundreds of puts and calls on the nearest maturity.
Since you trade multi-bank, I don't see any consideration maybe if you trade the futures, you have a dividend expectation.
We ignored that. If you had dividend, you'd need to work it into your model.
Yeah,
It would change the payouts, I believe, for your investments in that asset class. Yeah.
we have a drift because dividends SPX is more or less expected. So you can't have a drift. You can trade also dividend futures.
Okay.
So you can adjust. It's not exactly because you want to know, see? So you normally guess if a company changes dividend a particular day,
Hmm.
you have a drift a particular day.
Okay, I would not include that kind of. So he's talking about the dividends affecting the payouts of the futures. Like I said, what we trade here are contingent claims whose payout only depend on the index value at maturity. That sounds like an asset where that's not the case. So we could not include that in our model. Maybe our modeling of the futures here is slightly unrealistic because of that. I don't know. I'll look into that.
Dividend future dividend is upward about 7 dividends a day, and now it's going to change the dividend tomorrow. So you have a drift.
But we're talking about the index.
Yeah, but the index is part of stocks.
True.
Depends if somebody change the dividend, it tends to be a random day.
Okay.
There is the dividend, you can trade the dividend futures, so you could adjust for that.
Okay. I need to come back to that. If there's a problem with this, we could simply drop this. It's just one asset. We have hundreds of puts and calls. And in many cases, we actually don't even assume this. You can always replicate the futures payout by using puts and calls. That's the usual put-call parity. If there's any complications with that, I would just drop it from the model. You don't change the results much. And yes, all the payouts are concave. So then here's just to give a flavor of what the quotes look like. Here are, we look at two options, one call, one put, one forward. What you get from the Bloomberg is indeed the best ask, the best bid. You have the quantity on the best ask, you have the quantity on the best bid. And these are in the trading lots. I think they are like 100 options at a time. We have these for all the hundreds of strikes that are available for the nearest maturity options. And then the cost of trading things. So those were the payouts of the things that we are trading. The cost of trading things For options, if you buy, if you go long, you pay the ask price. If you go short, you get the bid price. For futures, it doesn't cost anything to enter the position. And here we are, so far, we ignoring the margin requirements. Margin requirements would be portfolio constraints that you need to impose on your portfolio vector. That's it, capital D in the general model. For cash, the price is simply 1. You get different rates for lending and borrowing. And then the portfolio constraints can be used to model the available quantities. You cannot buy more than is available at the best ask quantity. The same for selling. We could easily look at further price levels and incorporate those into the market model. It's still convex model. All the theory goes through exactly the same way. It's still a convex problem. You can still compute the same way. We are going to use interior point solvers, primal dual interior point solvers. We can solve these problems in a couple of seconds, and I'll show you the results in a minute. So here's the problem. It looks slightly different from what I have on the previous slide set. We still have the portfolio constraint. Here's now the budget constraint. Now the market is no longer perfectly liquid. We have different prices for buying and selling. When you buy, your price is higher. When you sell, you get the worst price. And this SJ0 is the price of buying XJ units of asset J at time 0. So this is determined by the ask price and the bid price. I had it here. For options, well, for all the assets, it's this. It's a beautiful convex sublinear function, positively homogeneous. And then your net claim that you have to cover at the end is, this is the claim the agent had in his books before any trades, so that will be relevant when we go and price those digital options and so forth. This C will be that. And then this is the total payout that you collect from your investment portfolio. You just sum those payouts over all assets together. That's it. So we changed the market model slightly. Now we have nonlinear functions, S and P here. And then in this example, like I mentioned earlier, we're looking at maximizing the expected utility. Or V here is the negative of the utility function. Some people call it the loss function. It's some non-decreasing convex function that describes the agent's risk preferences. And again, very subjective things depends on our model for the random variables under which the expectation is computed. It depends on our loss function V, depends on our financial position encoded by W and C. But it's a convex problem indeed. And this slide is about how we solve the problem in practice. First of all, we double the number of variables. We represent every position xj as a difference between of the positive part and the negative part. Those variables are then constrained to be non-negative. This results in an optimization problem where you have 884 decision variables. So you get the number of puts and calls times 2. Because you split the variables into 2. And then you have 1,700 constraints, a bit more, but now they are smooth functions. If you go back to the previous slide. Here you had non-smooth functions here. When we split the variables, when you represent this function as the sum of those cost for buying and the revenue from selling is the sum of 2 linear functions where the variables are constrained to be non-negative. And then you have those constraints for all of these. They all have to be non-negative. And then it's a convex optimization problem represented by smooth constraints, differentiable objective. What we do, we approximate the objective function, the expectation there, by an integration quadrature. That's another approximation with a potential approximation error. But once we've done that, then we have algebraically represented problem that you can simply write in MATLAB, feed into a solver, and hit enter. It pops out. Well, here we are using the Mosaic interior point solver. It's a commercial solver, free for academic use. It's, in my experience, one of the most powerful solvers around there. I had no reason to advertise it. I just found it fast. And it takes about 11 seconds to set up the problem in MATLAB. Then when it's fed into Mosaic, it takes about 4 seconds to solve it on a laptop. And then the results. We're going to use exponential utility, where we scale everything by the initial wealth, and then we look at different risk aversion parameters, lambda. Our initial wealth in these examples will be $100,000. We model the value of the index at maturity by t distribution. We assume 0 mean, and then the other parameters, the scale parameter and the degrees of freedom, were estimated from historical data, of daily data. And then we took the quotes from Bloomberg at one instant in time. We took them on in April the 8th, 2016, at 2:55 in the afternoon. At that instant, we downloaded all the hundreds of quotes, ask prices, bid prices, and the associated quantities available for all the traded instruments. We assumed different lending and borrowing rates. I can't remember where those came from. Again, those are things that would depend on the particular trader. We all would get different deals. But that's the data that we feed into the model and then solve it. Here are the results. Here are blue and red are results with different risk aversions. Here are the portfolios. You have calls. The vertical axis is the range of strikes available. You take positive position in one of the calls, negative in another, and nothing else. And this is indeed typical in these examples. When you do have bid-ask spreads, your solutions tend to be sparse. Like in most assets, you take 0 positions. For puts, you take 2 short positions, 1 long, and then there's something in the forward, something in cash, and that's it. So what do you have? 1, 2, 3, 4, 5, 6, 7 non-zero trades. We had hundreds of options available, but we don't care about most of them. And this is the same thing for different risk aversion. What you have here on the left corner is the payout of your optimal portfolio as a function of the underlying at maturity. So the blue one is with the lower risk aversion. It gives nice payouts here. The black line here is where the underlying price was at the time 0. If you increase risk aversion, then you get, like you would expect, slightly more cautious payouts. Here are the distributions of the payouts. This is as a function of the value of the underlying. This is like a distribution of your terminal wealth. Blue is with the lower risk aversion. If you increase risk aversion, you get, as you'd expect, narrower, more deterministic net wealth. Here's a comparison. Again, I mentioned that we get sparse portfolios in most cases because of the bid-ask spreads. Here's what happens if you ignore the bid-ask spread. If you replace the bid and the ask by the mid price, then it's optimal to trade almost everything. And the red lines here, they are the quantity constraints. So you trade almost everything, almost as much as you can. This is the terminal payout as a function of your underlying. Very, very wiggly. But that's what you would get if you were to I don't know, calibrate things to the mid price or trade at the mid price. It's not a very sensible. First of all, it would be very difficult to implement this. You would have to trade pretty much everything. Here's a result we would get if we exaggerate the transaction cost by 10% of both sides, bid and ask. You get slightly smaller positions. It's not much sparser than the original. So it's not much different. So for practical purposes, it might make sense to exaggerate the prices a bit, just in case that when you solve the problem within the couple of seconds, when you want to submit those orders based on the optimal solution, something may have changed a little. And to hedge against that, you could simply solve the model with the slightly exaggerated bid-ask spread. But the results remain pretty much the same. Then here are the effect of your views if you solve the problem with different models of the underlying value at maturity. Here are the underlying distributions, and here are the optimal payouts that you would get after optimization and looking at the payout as a function of the underlying. If you assume that you have very much uncertainty about where the underlying is going to be at maturity, then you're going to take this green position where you get good payouts far away from the current value. If you assume that the strike or the index is going to fall near its current value, then you're looking for portfolios that have good payouts there. And then you get this red and the blue one. Again, like you would expect, we are just quantifying what you would expect. And here's a funny thing. We look more systematically. First of all, here we simply assume normal distribution for the underlying to make things simple. So degrees of freedom is infinity. And then we vary the drift and the volatility of the underlying under now the physical measure P. And then for every point in the grid of mu and sigma, we solve the optimization problem and record the optimal value. You get this kind of surface. And it seems to have the highest values near the area where reasonable values for mu and sigma would be. So it's kind of a very complicated way to calibrate your mu and sigma to the market quotes of the options. I can't say much more about it. I find it puzzling. I find it difficult to interpret. But I thought it's interesting.
So how does it compare with the actual prices of what's being traded in the market?
Well, if you look at implied vols and stuff like that
that's what I
across all the hundreds of options, they would be around there.
I see.
And the drift here, I think, is you can't really see, but it's near zero somewhere. Yeah. I found it a bit puzzling. I just thought it's
Do you
nice.
have some kind of uncertainty quantification of what, like if you change some of the stocks, how?
Yeah, I look at sensitivities at the end.
Yes.
How do our results change when you change your parameters in the problem? Then the pricing part, the interesting part. We now have this optimization model. We can develop the indifference prices based on that. But should we have a break here? I could then finish this and then look at the dynamic setting after.
Okay. Well, let's thank Teemu for the nice talk. I have a few announcements.